Markets may remain choppy in 2023 as investors manage, possibly sliding profits and rates that remain elevated for longer than anticipated. However, I predict the market will most likely trade sideways rather than in a severe decline or upswing for the rest of the year. Bonds may give stronger support to investors' portfolios in 2023 than they did in 2018. We'll talk about the stocks down and bonds up in 2023. In this video, stay tuned and watch the full video to know all about it. Don't forget to subscribe to our channel. Even in relatively calm years, the market experiences some ups and downs. Hopefully, the market's inevitable waves will be manageable by 2023. However, I believe we must prepare for the possibility that they will be more treacherous. My guess is that 2023 will be a choppy sideways market. I believe that choppiness could include one or more declines that take us back to the market's mid-October low, which was the low for this bear market so far, but not necessarily much lower. However, I do not believe we are nearing the start of a new bull market. According to my assessment, there are at least a few waves, or risks, on the horizon that could rock investors' boats in the coming year. The dangers of falling earnings and recession. Earnings have now been widely agreed to have peaked. Earnings estimates are declining, and the percentage of companies experiencing earnings downgrades is increasing. There have been many times when estimates have fallen as much as they are now, but it has always turned out to be a temporary slowdown within a larger earnings growth cycle. However, there is one reason to believe that this earnings slowdown could be the start of something bigger, and that is the yield curve. In normal times of stable economic growth, the yield curve is generally upward sloping, with longer-term bond yields higher and shorter-term bond yields lower. This relationship has historically flipped in the lead up to a recession, which is why an inverted yield curve, with short-term rates higher than long-term rates, is often seen as an omen of a coming recession. The yield curve has not been this inverted since the early 1980s. While it is tempting to try to explain away the signal, it is also worth noting that it is now inverted pretty much regardless of how you slice or define the yield curve, as shown in the chart below. A challenge is that historically, an inverted yield curve has predicted a downturn anywhere from a few months to a few years before it occurs. However, this is a warning sign that should not be ignored. My guess is that a recession will occur in the second half of 2023. If this is the case, earnings could be jeopardized until 2024. What does this mean for the market's trajectory? Stock prices have historically bottomed out well ahead of earnings, with a recovery beginning about 2 quarters before earnings. So, if the earnings contraction continues into 2023, it does not necessarily imply that the bear market will last until the end of 2023. However, it is possible that the recent October low will not be remembered as the bottom of this bear market. The risk that the Fed maintains its current policy. The market currently expects the Fed to raise the federal funds rate to around 5% before cutting rates to around 3%, a rate that would not be considered restrictive in 2024. The market is pricing in this rapid rate cut even though Fed Chair Powell stated at last week's Federal Open Market Committee (FOMC) meaning that the Fed may remain in the restrictive zone for some time. The Fed even released a new dot plot, a chart that shows, with anonymous dots, each individual committee member's personal assessment of appropriate monetary policy for the coming years and the long run last week. The new dots showed that FOMC members generally believe the federal funds rate would need to remain above 4.5% in 2023 and above 4% in 2024. However, the market is still betting on a quick return to lower rates. Do not fight the Fed, as the old adage goes. The risk here is that the Fed is correct and markets are incorrect in projecting the path of policy in 2023, and that financial conditions will remain tighter for longer. Why is this important for stocks? Interest rates have a direct impact on stock valuations via the discounted cash flow model, with higher rates implying lower fair values for stocks. The market's rally since the mid-October low appears to have been based on the expectation that the Fed would pivot, cutting rates before earnings deteriorated significantly further. In essence, the market rallied because investors were looking beyond the expected peak of this rate hike cycle. However, if interest rates remain higher for longer than investors expect, the recent rally may not be justified. Based on the discounted cash flow model and the Fed cycle, a fair value price earnings (PE) ratio for the S&P Wink with tongue sticking out 500 is around 15. Applying that fair value PE to trailing S&P Wink with tongue sticking out earnings of $217 per share results in a fair value level for the index of around 255, about 600 points or 16% below the market's close last week. Patience and variety are virtues. Patience is a life skill that will likely come in handy in 2023. The market's 2022 decline has taken the air out of the asset price inflation that was fueled by the market's pandemic-era surge, and it is now back in its long-term channel. Diversification may also benefit investors in 2023. While large-cap U.S. growth has been a profitable sector for much of the last decade, a shift appears to be taking place. For the coming year, I believe value will outperform growth, small caps will outperform large caps, and non-U.S. stocks will outperform U.S. stocks, at least on a relative basis. Small caps are currently relatively inexpensive, with an average PE ratio of around 12.5. Furthermore, if the U.S. dollar continues to weaken, non-U.S. stocks, particularly emerging market stocks, could see continued relative earnings improvement. Even if some of the aforementioned waves do rock the boats of stock investors in 2023, I believe bonds will continue to provide some ballast in a diversified portfolio, as they have since October. With the rise in yields and fall in inflation expectations over 2022, real yields are now clearly positive, meaning yields after subtracting for inflation. Bonds, in my opinion, are a viable asset class for 2023. Risks to the downside and the upside. Overall, I expect 2023 to be a choppy year for stocks, with plenty of waves, but ultimately, I believe it will be a year without a significant up or downtrend. And I believe that the bond side of investors' portfolios may work even if the stock side does not. What could cause my cautious outlook to be incorrect? The most likely downside risk is a major earnings storm, though, as previously stated, because stock prices have historically bottomed before earnings, this does not necessarily mean that stocks will follow earnings all the way down. My guess is that if I am wrong about my choppy, sideways outlook, it is because the market has already bottomed, and we are in the early stages of a new bull market. Such an outcome would be supported by an improving inflation narrative and, as a result, a friendlier Fed. For the time being, I am hoping for something in the middle. I really hope you liked seeing this video. Please ensure that you subscribe to our channel. And give this video a thumbs up in order to show your support. Remember to click the bell symbol in order to get notifications about forthcoming events.